Good morning, everyone, from sunny, beautiful Calgary. We will just give everyone a couple more minutes just to sign in and to bring up the screen for the presentation to start. My name is Dinara Millington, and I'm Vice President of Research at the Canadian Energy Research Institute, as well as your host and presenter for this morning's webinar that's titled Competitive Analysis of Canadian LNG. So stay with us for a couple more minutes and we will start shortly. All right, and we are going to begin webinar again on the competitive analysis of Canadian LNG research that the Institute has conducted last year. But we have some updated results that we will be presenting in this morning's webinar. All right, just a couple of housekeeping guidelines before we start. Your microphone on your end has been muted for the duration of the presentation. You will be able to hear me, but I won't be able to hear you. If you are not receiving your audio through the computer, there's option to also dial in. We will accept questions at the end of the presentation. We should have plenty of time for question and answer period. But feel free to type in your questions as we go along. I will just address them at the end of the presentation. Also, a copy of this presentation is available to you to download, as well as upon the conclusion of the webinar, recording of this webinar would also be sent out to you by our marketing team. All right. If you're not familiar with us, Canadian Energy Research Institute has been around since 1975, and we're a non-for-profit charitable organization specializing in analysis of energy economics and related environmental issues when it comes to Canadian energy supply and demand chain, everything from upstream energy production through transportation, midstream processing, and final end-use consumption. Our mission is to provide relevant, independent, and objective research for the benefit of the public, businesses, government, and academia. We publish approximately 8 major studies per year, but however, with that, we also do regular energy quarterly updates, a monthly geopolitics of energy journal, as well as CERI hosts an annual petrochemical conference in Kananaskis. We are fortunate enough to receive our core funding from the following organizations: Natural Resources Canada, the Department of Energy with Alberta Government, and the Canadian Association of Petroleum Producers. We also receive funding support from the Canadian Energy Pipeline Association, the University of Calgary, Chemistry Industry Association of Canada, Alberta Industrial Heartland, and the provincial governments of British Columbia and Government of Saskatchewan, as well as the IV Foundation. Our in-kind supporters include Alberta Energy Regulator, Bow Valley College, NATE, June Warren Energy, and Petroleum Services Association of Canada. The agenda for this morning's presentation, we will take a look at what's been happening in the global LNG market and look at some of the supply and demand numbers. And then we will dive deeper into what entailed our analysis, looking at the methodology and assumptions behind our calculations of LNG supply costs. And then we will go into analysis around what are the competitiveness factors that will impact the Canadian LNG facilities as they compete with other LNG suppliers around the world. Then I'll conclude with some of the remarks, and then we will go into a Q&A period. All right. Since we did this study, we've updated some of the statistics to include the most recent historical years, and what we're seeing is a continuing increasing trend in LNG trade. For the second year on a row, global LNG trade has increased by almost 30 million tons, setting a new record at 316.5 million tons per year of LNG demand. Combined, this has been the strongest growth period for international LNG. What the market has seen is about 10% year-over-year growth, which was led by additional liquefaction capacity that was added by Australia at 12 million tons, the United States, Gulf of Mexico specifically, at just over 8 million tons. And on the demand side, China has shown the largest demand growth, adding additional incremental 15.8 million tons in 2018. Overall, since year 2000, LNG demand has experienced 6.5% of average annual growth year over year. When we look at who are the suppliers of LNG in the global market, in 2018, there were 19 exporting nations, which are broken down here on your screen by their LNG supply, which is the first number, and then in the percentages you see their market share in that particular year. Qatar continues to dominate the LNG supply at just about a quarter of total LNG market. However, this year, Australia is closing the gap between Qatar and themselves by additional 10 million tons in 2018. Also, another note that is worth mentioning is that United States had, with additional liquefaction capacity, they've managed to jump to the 4th spot on the LNG market share of all the suppliers. So here is just a little breakdown of the LNG suppliers and what has happened between 2017 and 2018. As you can see here on your graph, as I mentioned already, Australia added the most of liquefaction capacity year over year by additional 12.2 million tons of liquefaction capacity, closely followed by United States and Russia. There are, however, 8 markets that have failed to match their 2017 totals. For example, Indonesia, where they've declined by almost a million ton, 1 million ton, and that is to do with aging gas basins, and some of the natural gas that was extracted was used for domestic supply. And countries, for example, in Algeria, they've diverted the natural gas that was extracted from the being transported in LNG form to pipeline gas. Switching to LNG demand, again, this is 2018 market share of all the countries that have imported LNG. Again, story here is that Asian Pacific areas and Southeast Asia continue to dominate the LNG global markets, with Japan and China being the largest importers of LNG. Within the LNG trade, what we're seeing is a continuous growth in short-term LNG trade. About 31% of total LNG trade has occurred in short-term interregional movements within the countries of Inter-Pacific region. Oh, sorry, and I guess the slide, the previous slide, the others include imports that are less than 2 million tons, and those countries include countries like Poland, Netherlands, Brazil, Malaysia, Dominican Republic, Bangladesh, and so on. Looking at the incremental changes between 2017 and 2018, on the LNG import side, we are seeing China continue to dominate the LNG growth, followed by South Korea, India, and Pakistan. I have added the regasification facilities recently. All right, so what are we seeing in the markets? Well, Asia continues to be the driver of the international LNG demand growth. The natural gas supply to feed LNG facilities is continued to come from unconventional resources, especially in the United States, from the shale gas development. What we're seeing is changes in the business model. As I said, about 30% of LNG trade happens within short-term interregional trade, where the LNG tankers get diverted to other markets. We're seeing within a year between 2017 and 2018, we see 4 additional floating LNG facilities that are either under construction or becoming operational, and so this has to do with the areas where the gas basins are remote, and the justification of building a lengthy and costly pipeline is not there, and the FLNG comes as a solution to bring the competitiveness of these facilities on par with the onshore LNG facilities. Also, with some of the environmental policies that are coming out specifically in China, where they are looking at switching from coal service to generate electricity to natural gas, we're going to continue to see a large demand growth for LNG in those countries. A little bit closer to home, at the time of writing, we looked at 35 LNG export licenses that have been issued by the Canadian Energy Regulator. Some of the key projects that we have looked at and that are mentioned here include 2 facilities in the Atlantic Canada, on the eastern coast of Canada. These are the Pierre de Goldboro LNG in Nova Scotia. That project had pushed its final investment decision to end of 2019, first quarter of 2020. The Bearhead LNG in Nova Scotia actually has been quiet, but they have received some construction permits and an export license. The small wood fiber LNG facility on the coast of British Columbia is a merchant facility and is active. The one facility that is currently under construction is the LNG Canada project, which is a consortium of 6 LNG partners. That project is building its first 2 trains with the plans of expanding and doubling its capacity. And that project had reached this FID and it's currently under construction. The Chevron Kitimat LNG project is also an integrated project with the upstream natural gas resources. However, that project has not issued an FID. Yeah, sort of stay tuned. We're looking forward to some movements along some of these projects and some of the announcements. What we have done is we've taken a look, when we did our analysis, we've taken a look at 6 different hypothetical LNG projects in 5 jurisdictions. We looked at 2 in Canada, 1 on each coast in the east and west of Canada, 1 in Australia, and 3 in the US Gulf of Mexico. The sum of the cases and sensitivities we ran along evaluation of these 6 projects have to do with cases such as where liquefaction is added to regasification to calculate the full project costs there. We looked at the economies of scale, where we look at expanding the capacity and looking and analyzing what happens to supply costs then. And we looked at projects. Most of the projects are greenfield design. However, one of the facilities in the United States, we've taken a brownfield project. On the natural gas feedstock costs, there are multiple scenarios that we run where the feedstock is purchased off the market, like ACO-C, for example, or if it's an integrated LNG project, then we've taken into consideration the upstream supply costs of natural gas production, specifically in Montney Montney, Horn River, and Horton Bluff for Eastern Nova Scotia for Eastern project. We also evaluated the transportation costs, because some of these projects will require additional pipeline capacity or even a build of a new linear transportation project. And then we also included the calculation of the shipping of the LNG to the markets in Japan and Europe to evaluate what the full cost assessment would be. All right, what you see here is some of the costs that are associated with the natural gas that would be required to feed the LNG facilities. It's here what's noteworthy to mention, as you can see, that the Canadian basins, Montney and Horton Bluff, our prices are a lot more competitive than those, and for example, Henry Hub prices. These prices are Henry Hub forecast price was taken from the US Energy Information Administration. And all the other costs were sort of adjusted by discounting to the basins. However, when it comes to supply cost calculation, if it's an integrated business model, then what we've included, instead of looking at the pure price forecast, we've taken account the upstream supply costs, because through our modeling, we're able to calculate what those supply costs would be in the Montney and Horton Bluff Shale and Nova Scotia. All right, again, some of these prices are a little bit outdated, but this is what we compared our supply cost of LNG to the price points in markets in Asia as well as Europe. Just to give you an update, the Northeast Asian price in 2018 averaged about $9.78 per million BTU. And the prices in Europe, specifically in UK, in 2018 averaged about $7.44 per MBTU, just to give you a perspective where the prices are at currently. What you see here is non-optimized supply costs of LNG on Western Canadian coast. When we've done the calculations and we looked at what some of the capex and opex would be, we've gathered publicly available information on predominantly in LNG Canada, because it's the first one out there with some of the information that we're able to gather. When I say non-optimized, I will get back to that, because there's a slide coming up that looks at how you can bring the costs, the upstream, the total LNG supply costs down even further. What I will do here is, you see the costs in both US and Canadian dollars. From now on, I will be mostly referring to cost in US dollars per MBTU. But basically what this slide shows you is that well, first of all, what's noticeable is that the economies of scale do play a big factor in lowering the overall costs. as well as you can see, some of the other elements do contribute to the total number of the total cost number. So things like feedstock, obviously, feedstock, natural gas, the capital, the taxes, and so on. Here are the non-optimized LNG costs of Eastern Canadian LNG project. Again, here we've taken a look at what would feed that project. So one of the cases that we ran was to look at bringing Western Canadian natural gas. As you can see, that's the first two columns on your slide. This is the ECO C gas. Being transported from Western Canada to Eastern Canada. Then we looked at the case where the Eastern Canadian LNG could potentially import the natural gas from a closed shale gas basin, and that is in the United States, the Marcellus natural gas. The feedstock costs are fairly similar there, and this is to do with the upstream natural gas supply costs are lower in Western Canada than they are in Marcellus, but the transportation of that gas is higher, and so they even out by the time they get to a location of Eastern Canadian LNG. And then the third option is we looked at sourcing domestic shale gas from the Horton Bluff Shale. And what those, and obviously by sourcing the domestic gas, it overall costs are significantly lower than sourcing natural gas from Western Canada or even the United States Marcellus. So when we did the analysis, we wanted to sort of understand what causing different elements and what are the price points are. We have come up with a few differentiators, or I guess you can call them competitiveness factors. By no means this is a full list, so I would encourage you to take a look at the full study that is available online. Here I'm just going to identify some of the more pronounced factors, so to say. And the first one, right off the get-go, is the abundant gas supply in North American continent, I would say, specifically along the Western Canadian Sedimentary Basin, and then as well as the shale resources of the Marcellus and Utica Shale. The amount of resource available there, it's able to easily accommodate several LNG projects and satisfy the domestic demand use of natural gas and the pipeline exports within Canada and from Canada to the US markets. The proximity to demand markets, and so this is where you want to reach your LNG buyers, is also a competitive advantage. From the eastern coast, it is 8 days of voyage to European markets, which is less than or comparative to Russian Arctic LNG, and edges the US, Gulf of Mexico, and Africa by 5 days, and Qatar by 12 days. From the west coast of Canada to travel to Asian markets, for example, to Japan, we also have a competitive advantage in terms of the days of travel and voyage in comparison to those facilities that are shipping LNG from US Gulf Coast, for example. However, on the not such a plus side, I guess, the uncertainty when it comes to building large linear infrastructure projects like pipelines that would feed the natural gas LNG facilities with the feedstock gas from the upstream gas locations is definitely something that has come as a highlight and uncertainty. Also, I would add to that is the uncertainty when it comes to application of the new impact assessment and how, especially on the cumulative and regional impact assessment, and how additional LNG facilities would impact that. And the last one that I want to sort of mention is the lack of domestic experience in LNG plant construction and operation in Canada. That element of itself will translate to uncertainty around project execution, which potentially could equate to higher risk when it comes to operating and building Canadian LNG. In comparison to jurisdictions that have already established LNG industry. All right. Here we've broken down the costs that you saw on the previous slides into a, I guess, a more visually attractive way to show these costs. So what I'd like you to sort of pay attention to is how costs evolve when you go from a merchant business model to an integrated business model. By integrating your upstream natural gas production, transportation with your liquefaction and shipping, the producer would reduce supply costs of LNG significantly. As you can see by the blue portion of the bar, which refers to the feedstock gas, within the integrated model, the feedstock gas is quite significantly lower for Western Canada, and that is to do with within the integrated model, the producer would only be facing the upstream supply cost of Montney as opposed to buying it straight off the AECO market. Another note worthwhile mentioning is if you look at the yellow portion of the chart, and that looks at the pipeline transportation cost. And as you can see, by sourcing natural gas from Western Canada to feed Eastern Canadian LNG facilities, you would require, in our analysis, we put in additional pipeline that would be required to connect natural gas from where Trans-Canada Mainline ends to the eastern location of the facility, and that translates to a quite significant transportation cost of that gas. However, if Eastern Canadian facilities do source domestically produced Horton Bluff shale gas, that transportation cost is obviously minimized. All right, and this is a little bit to look at the netback analysis. Again, some of these horizontal lines which refer to market prices, those are a little bit outdated, but as I mentioned to you in 2018, the prices in Japan was close to $10 at $9.78 per MBTU. And so when you look at the Western Canadian LNG facilities and compare those to projects in Australia or even US, we can see that Western Canadian LNG production and facility project would compete with the natural gas that's supplied from locations such as Australia and the US. When it comes to Eastern Canadian LNG facilities, those do not compete in Asian markets, specifically in markets in Japan. But however, this probably is not the most preferred route. I would venture out and say that the ideal customer for Eastern Canadian LNG would be located closer to Eastern Canada, somewhere, markets somewhere like Europe or specifically UK. And I'll show you that slide a little bit later. All right, and this is sort of what I was mentioning when I talked about the optimized and non-optimized cost. So what we did is we did an assessment. Once we calculated what the initial supply cost would be of a facility, and this particular example is Western Canadian LNG, coming at almost $9 per MBTU, including the shipping cost in Japan. And what are the various elements that could bring that cost down? So already at the time of writing, the LNG Canada has applied for steel duty exemption to federal government as well as BC government to look at what are some of the incentives that would be available. So already that project has gained those factors and has managed to bring that cost down to $8.57, as you see on the chart. So we already starting point here. As you can see, with the plant expansion to doubling the capacity of the going from 13 million tons to 26 would reduce the cost by additional 77 cents per MBTU. And what we also looked at is the revenues that LNG producer will be able to capture through the evaluation of natural gas liquids and potential revenue stream that will be coming there. We've calculated that as additional 25 cents on BTU, and that optimized cost comes down to $6.91, and you include the shipping of 64 cents to bring us to total of $7.55 per MBTU is what we call the sort of optimized supply cost of LNG at markets in Japan. All right, so similar slide, but looking at markets in Europe and specifically in United Kingdom. We wanted to see how, again, Canadian facilities compete with those in the projects and those that are constructed in Australia and the US. And as you can see, that if Eastern Canadian LNG facility sources the domestically available Horton Bluff shale gas, they're able to compete in the markets in UK. However, it does become a bit of problematic when it comes to the sort of overall competitiveness when that gas is sourced from other regions such as AECO Western Canada, AECO C, and Marcellus. Excuse me. All right, and then we did a similar exercise looking at the path to competitiveness for Eastern Canadian LNG facilities. Again, our starting point is the initial supply cost and the shipping cost to UK, and what are the various elements that potentially could reduce that cost. And we looked at similar elements as in the Western Canadian LNG case, and what we see is the biggest, I guess, the biggest factors that could contribute to minimizing that cost is, again, economies of scale and additional cost efficiency. And here we're referring to specifically the pipeline, the transportation by pipeline. So what are we referring here is potentially not building a new pipeline and expanding the existing Maritimes and Northeast by adding additional compression. And so what does it add up to is a reduction of cost from, we went from almost $11.60 to down to $8.80. And at that optimized cost, if the facility is able to capture all those elements, then that facility would definitely compete without a doubt in the UK, European markets with the facilities where natural gas is being brought from locations such as UK or Middle East even. All right, and just in sort of to conclude all the different elements that I talked about, is we're going to see a continuous increase in the global trade of LNG as there's more LNG liquefaction capacity is under construction and being built. Demand is continue to grow as the coal to natural gas switching happens, and as the some of the less developed countries bring their standard of living higher, and then obviously with that, what you usually see is energy demand increasing. On the competitiveness factors, we'll see if the local gas is available to Eastern integrated projects, and this is a big if because currently there's a moratorium on natural gas fracking in Nova Scotia and New Brunswick. Those projects will become slightly competitive than even Western projects in Canada. excuse me, merchant projects in the West are more competitive due to proximity to AECO as opposed to Eastern Canadian sourcing AECO gas. Incentives are a factor in project economics. As we see, LNG Canada had received their steel tariff exemption and LNG tax exemption. So if other facilities could follow suit, there would be some savings there. In the Asian markets, Canadian projects are slightly more expensive than Japan's spot price, but again, that spot price varies day to day, and the project economics are done on a 40+ year project life. And so when you look at the overall averages, long-term averages of the LNG prices, we are seeing that Canadian projects are going to be able to compete. And then in the European markets, again, Canadian projects are slightly more expensive than the spot prices that are being traded for LNG in the UK. Again, a big factor to watch out for is the pipeline gas that could potentially feed the European markets at a cheaper cost than the LNG gas. And I guess the big uncertainty is what is Gazprom going to do? And then when it comes to competition with other projects, U.S. projects, specifically U.S. Gulf of Mexico projects, are slightly more competitive than Eastern Canadian projects in the European markets. All right, so with that said, I would like to thank you for your attention. We have lots of time for Q&A, and I think we have one question here. So what I'll do is I'll read the question out loud so everybody can hear it. So the question is, do you know that Eastern Canada is the closest location in North America to India? So that's a really good question. I would say it'd probably be close voyage time as US Gulf of Mexico. I do have some stats. Let me just pull what that travel voyage is to India. All right, so through Suez Canal is 24 days of travel. And we are disadvantaged in that travel voyage to locations in West Africa, Australia, and Qatar, but not to the US Gulf of Mexico, which actually already ships 1 billion cubic foot of gas to India. So it does prove the viability of LNG going to that market, even from a less advantaged location such as US Gulf. So I guess we would be, even though the travel voyage is longer than to the Japanese market, I think we would still have a competitive advantage over the US Gulf. Eastern Canada to India is closer than Western Canada to India. Correct. All right. Do we wrap it up or do we wait for more questions? So another element that's always being asked is what's going to happen to local gas prices at AECO if we're going to see a large amount of gas now being shipped in the LNG form as opposed to pipeline exports. I think in the evolution of LNG industry, we will definitely see some of that impact affecting the prices domestically. However, in the short to medium term, I don't see how LNG would bring prices of natural gas in domestic markets to the point where they become too prohibitive for industries that use natural gas, such as, for example, oil sands. All right, so another question is, in BC, there's a strong push towards sustainable electrification of the value chain. In some scenarios, this may represent a significant cost increase relative to conventional gas-fueled infrastructure. What were your assumptions in this regard? Thank you for the question. That's a really great question. So in our assessment of supply cost of Western Canadian LNG, we assume that on the operation side of the LNG facility, it's natural gas that's being used as the fuel of choice to electrify the facility. But you are correct, with the build of the Site C dam in British Columbia, there's a strong potential that facilities would be utilizing hydropower to power their facilities and maintain the energy intensity and emission intensity at the lowest level. As far as I know, LNG Canada to date would be the lowest emission intensity LNG facility in the world. All right, question came on the around the delay. What is the effect of delay to start project in the next 5 years compared to the 10 years? That's a good question in terms of what is that. What does any delay, whether it's within the regulatory time frame or down the line, once you start the construction of the, I mean, it would definitely have an impact on the project economics. But also what we need to be mindful of is Canada is not in, Canadian markets are not in a bubble. We're not, you know, as we're moving along and as the plans to build LNG facilities happens along the west and east coast, we need to be mindful what are the other facilities that are being added continuously, and where, you know, where those times, the times of fluctuation in a market where LNG supply might potentially outpace the LNG demand or vice versa. And so not only are the project economics are important to LNG producer, but also overall LNG supply and demand picture, and sort of where does Canada, where do facilities sort of start operating to take advantage of a situation where they're not stranded and they're able to find a buyer. So I don't have exact sort of dollar per MBTU, what is that effect of a delay, but we do have a project coming out within the next few weeks that looks at the cost of delay when it comes to oil and gas regulation. So I would say stay tuned for another webinar to answer that question. You're welcome. All right. Thank you very much for your attention this morning, and I strongly encourage you to download the study. This was definitely just sort of the top layer of the summary results. There's a lot more great information inside the report, and what I would like to do is announce next webinar that will be coming up in about a week's time on December 10th, that looks at electricity versus fossil fuels. So we will encourage you to register for that one as well. And thank you very much for your time today, and have a wonderful day. Take care. Bye-bye.